The second promotion came with a slightly larger office and a benefits packet thick enough to feel like progress. The title changed, the salary adjusted upward, and the email signature carried more weight than it had the year before. It was the kind of advancement that fit neatly into a LinkedIn update and a short conversation with family over dinner. Nothing dramatic, just steady. At 36, he had been with the same regional insurance firm for 11 years. The path had unfolded in predictable steps: analyst to senior analyst, then team lead, then department manager. Each move came with a modest raise, a slightly larger annual bonus, and more responsibility layered onto the same core function. The company paid reliably. Health insurance was comprehensive. The 401k match was consistent. Paid time off accrued without friction. Stability had become a defining feature of his adult life. He and his wife bought their first home 2 years after he joined the firm. It was a modest three-bedroom house in a growing suburb outside a mid-sized American city. The mortgage payment at the time felt heavy but manageable. Property taxes rose gradually. Insurance premiums shifted year to year. The home required maintenance. Nothing dramatic, just a slow drip of replacement appliances, roofing estimates, and landscaping costs. Each expense folded into a spreadsheet that was updated every Sunday evening. When their first child was born, the employer's health coverage absorbed most of the hospital bill. When their second arrived 3 years later, the deductible had increased slightly, but the system was familiar. He understood the claims process. He knew the benefits administrator by name. The company's stability blended into the background of family life. He received outside offers twice in his late 30s. One from a national competitor willing to pay 15% more base salary. Another from a smaller firm offering equity in exchange for joining at a more senior title. Both would have required relocation. Both involved leaving the known environment of his current employer. He declined them without much internal conflict. The mortgage still had 25 years remaining. Childcare expenses were substantial. His wife worked part-time after the second child was born, bringing in supplemental income but relying on his benefits coverage. The thought of entering a new health insurance system with a different deductible structure felt unnecessary. The base salary difference was meaningful, but not transformative. The equity offer was difficult to value. It carried possibility, but also ambiguity. At 40, he was earning a solid middle income salary for his region. Combined household income placed them comfortably above the national median. They contributed consistently to their 401ks. They funded 529 plans for both children. The emergency fund covered 6 months of expenses. On paper, the trajectory looked responsible. The company reorganized twice during that decade. Entire divisions were consolidated. A handful of colleagues accepted severance packages. His department remained intact. He absorbed additional responsibilities as others departed. The compensation adjustments that followed were incremental. The workload expanded faster than the salary did, but the checks continued to arrive on schedule. The realization did not come during a crisis. It came during a routine performance review at 43. His manager, younger by several years, outlined the long-term outlook. The company was prioritizing cost containment. Senior management positions above his level were limited. Advancement would likely mean lateral movement into adjacent functions rather than significant pay growth. Annual raises would track near inflation. Bonuses would depend heavily on departmental cost efficiency. The language was calm. The tone was professional. Nothing felt threatening. Driving home that evening, he calculated in his head what a 2 to 3% annual raise would look like over the next 15 years. He compared it silently to the offers he had declined. He thought about the equity he had walked away from, now part of a company that had since been acquired at a substantial valuation. Former colleagues occasionally mentioned stock payouts that exceeded several years of salary. His mortgage balance had declined steadily, but property taxes had climbed. Health insurance premiums increased annually, even within the stable employer plan. College tuition estimates, once abstract, were now approaching reality. The 529 projections assumed moderate market returns and continued contributions at the current rate. Any stagnation in income would compress that margin. The stability that once felt like insulation now felt like a ceiling. He did not experience panic. The house was not at risk. Retirement accounts were funded. There was no immediate threat to employment. But the shape of the next 2 decades appeared more fixed than he had expected. The company's pension plan had been frozen years earlier for new accruals. The 401k match remained, but the growth depended largely on his own contributions and market performance. He opened an old email folder one evening and reread the equity offer from years prior. The document described vesting schedules and projected growth scenarios. At the time, he had focused on the downside risk. The company could fail, the shares could be diluted, the relocation could disrupt their family routine. Those risks had been tangible. The upside had been theoretical. Now, the theoretical had become concrete for others. His own income had grown predictably but slowly. Over 15 years, the compounding effect of slightly higher starting salaries elsewhere would have altered his total lifetime earnings in measurable ways. He ran the numbers privately. Even assuming conservative annual raises at the competing firm, the cumulative difference crossed into six figures. With investment growth layered on top, the gap widened further. The cost was not visible month to month. It did not show up as a missed payment or a financial emergency. It appeared only when stretching the timeline. At 45, his daily routine was deeply entrenched. Commute, office, meetings, performance metrics, budget reviews. He was respected internally. His job security remained intact. But the external market value of his skills had plateaued. Recruiter outreach slowed. Industry certifications he once considered pursuing felt less urgent as years passed. His professional identity was tied almost entirely to one corporate structure. When healthcare premiums increased sharply one year, the company adjusted employee contributions upward. The change was absorbed into payroll deductions. It reduced net income slightly, but not catastrophically. Still, he noticed that the flexibility he once assumed existed within employer-sponsored benefits was narrower than expected. Decisions were centralized. Employees adapted. His wife returned to full-time work once the children were older. Their combined income rose meaningfully. For a period, it felt like acceleration. They increased retirement contributions, paid down the mortgage more aggressively, and considered modest renovations. But the long runway of predictable corporate raises remained unchanged. Her field offered limited upside as well. In conversations with friends who had moved between companies more frequently, he observed a different income pattern. Larger jumps early, occasional volatility, occasional periods of unemployment, but higher overall salary baselines by mid-career. Some experienced layoffs and recovered. Others shifted industries entirely. The variance was greater. So was the range of outcomes. He had optimized for the lower end of variance. At 50, he was one of the longest tenured managers in his division. Younger hires cycled through every few years. They negotiated aggressively upon entry. Their starting salaries sometimes approached his own, despite his years of experience. Internal compensation bands limited rapid adjustments for existing employees. Loyalty had not translated into exponential growth. It had translated into predictability. The mortgage was nearly half paid off. Retirement balances were healthy but not extraordinary. College tuition payments began to flow out of the 529 accounts. The projections were close, but not perfectly aligned with actual costs. Small gaps required cash flow adjustments. He calculated the opportunity cost again, this time against retirement. If his salary had been 15 to 20% higher for most of his 40s, the additional 401k contributions and employer matches would have compounded significantly. The difference in projected retirement income was not catastrophic, but it was noticeable. It might represent a few additional years of work beyond what he once assumed. He did not resent the company. It had delivered what it promised: stability, benefits, consistent employment. It had never guaranteed rapid wealth accumulation. The contract had been clear, even if unspoken. The realization settled gradually. Stability is not neutral. It carries its own long-term financial profile. The absence of risk narrows both downside and upside. Over decades, that narrowing shapes asset accumulation in ways that are invisible in any single year. At 53, another reorganization occurred. He retained his position, but two peers accepted voluntary exit packages. Severance calculations were based on tenure and salary. His package, had he taken it, would have been sizable. Yet finding comparable compensation externally at that stage of his career would have been uncertain. The market had evolved. Younger professionals with broader cross-industry exposure were often favored for new leadership roles. He remained. The children graduated college with modest remaining loan balances. Retirement contributions continued. The mortgage approached its final years. On paper, the life looked responsible, even disciplined. There were no dramatic failures, no financial collapses, no reckless decisions. But when he projected forward to retirement at 65, the monthly income estimate was more conservative than he once imagined in his 30s. The home would be paid off. Social security would supplement savings. Healthcare costs would rise. Long-term care remained an open variable. He sometimes imagined the alternate timeline, not in regret, but in contrast. A higher salary base earlier. More aggressive retirement funding. Perhaps a larger home, or perhaps the same home with a shorter mortgage term. Possibly the same life, but with a thicker margin. Instead, his margin was adequate. In quiet moments, reviewing annual statements, he understood that the cost of always choosing employer stability had not been visible risk. It had been muted growth. It had been compounding at a slower rate. It had been the gradual acceptance of internal salary bands instead of market recalibration. Nothing had gone wrong. Nothing had broken. The company still deposited paychecks every 2 weeks. The benefits portal still updated each January. The office remained in the same suburban complex, though now partially hybrid. His name remained on the organizational chart. The financial outcome of 3 decades of stability sat neatly inside retirement projections and home equity statements. It did not contain dramatic peaks or valleys. It contained a long, steady incline that never quite steepened. He closed the spreadsheet one evening and turned off the desk lamp in his home office. The room was quiet. The house, nearly paid for, held the accumulated evidence of consistent employment. Outside, the neighborhood looked unchanged from the day they moved in. The decision to remain had shaped everything gradually, almost invisibly. And now, with most of the working years behind him, the shape of that decision was fixed.